TFNN. Headline News Update. Here's Tom O'Brien.
Hi, folks. Basil Chapman sitting in for Tom O'Brien in this evergreen update, and it's my pleasure to be here. So let's just run the numbers. The S&P is down 13 at 2,085. Very important that it holds the 2,083 to 2,081 area, because that is important support in my work. If you're looking at my charts, you'll see that this is the daily chart, this is the weekly chart in the middle. On the right is the monthly chart right here, and this little chart right here is the 120-minute chart pulling back very sharply. And that shows you that around about 281 to 280, if that support goes, there's a real good chance that the resistance becomes this black line, the 9-period exponential moving average. Most importantly, what I'm looking at here is that as we're moving along, the Dow, you see, the S&P is down 0.70. The Dow at this particular point is down, excuse me, down 0.79, a little bit deeper. And it is just holding the 9-period exponential moving average. If the Dow closes today or tomorrow underneath 17,650, that's pretty important support. Then all of a sudden you're looking at the entire 17,600s as key support, and then you start looking at the 17,500s. Now, what's really important about this is that the resistance is going to be very strong in the 17,830 to 17,008, about 850 to 870 area, right in that mid 17,000. I'm sorry, I didn't mean that. Yeah, 17,000, yeah, 850s. Now, this is going to be very important as far as the market is concerned. The VIX index, the volatility index. Volatility index is rising. It's up 1.45, up 10% at 15.78. If, in fact, we get that volatility index pushing over the next 2 days above the high that was made last week of 16.39, then all of a sudden you've got this 200-period exponential moving average at 16,000. I would put it at six. I keep saying 1,000, 16.90s. That's going to be really important, because a close above that would be the first time in a while we've seen the volatility index close above the very critical 200-period exponential moving average. Let's move on, because we want to look at gold. Gold right now is, excuse me, gold is up about 90 cents at 1,088. Very sharp move down. It's really like a single leg down over the last 2.5 weeks. This means that the 1080 level is going to be critical to hold at 1088. There's just 8 points to go. The monthly chart on the right here is really not looking good. When we get to silver, I'll tell you right now, silver, like gold, is down sharply. It's down 12 cents at 14.57. Now, this is going to be key. The market is getting really afraid that, in fact, the interest rate sector has become, it's really alive for the first time in quite a while. Not if you're really looking, let me show you in the long-term chart situation. This is the 30-year yield. This is the 10-year. This is the 5-year. And you can see that there's a cup formation being formed here. So at 3.13% on the 30-year, we'll see, because 32.55 is going to be really important to monitor. I am missing out on a couple of things here. I want to look at the dollar. Look, the dollar just broke right out, and it's very strong today. It's up. It's actually now it's unchanged. It's at 99.17. Very important. So as I'm looking at these different criteria, we've got to be looking at the dollar is important. The Fed would like the dollar to pull back. We'll see if they're able to do that. And when I'm looking at the different components of the market, it tells me that the real estate sector, the REITs, the housing sector are getting very, very overbought, and they're pulling back quite sharply. So let me go through this again. This is the everbank.com. Go to the front page of the TFNN, check it out. Thank you so much for being here. And I'm sitting in for Tom O'Brien and Basil Chapman right here. I'll be doing the show coming up, Tom's show. Thank you for being here, and I do appreciate it. And what we're looking at here is over the period of the day, watch the levels we were talking about. If the volatility index keeps running, then the market should be pulling back further.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let falling markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.